Getting ahead of the Fed. More hints at a hawkish Fed, but some subtle differences in strategy here. Governor Christopher Waller suggesting he's amenable to a lower rate hike, while New York's John Williams calls for less reliance on monetary policy altogether. And then there's longtime hawk James Bullard. He just says that they must raise rates by another full percentage point. Let's dive into the details with Paul Schatz, who is the Heritage Capital president. Paul, great to have you here with us on set today.
Yeah, good to see you.
Good to see you too. So, is there a policy pathway that you would be most favorable of or supportive of if you saw that emerge from the FOMC?
Well, first, I think they should stop all rate hikes right now altogether.
Right now.
I think the Fed is always behind the curve. They've never, every Fed chair, Greenspan and Bernanke and Yellen, they've all made those outlandish statements that have been proven wrong. Now it's inflation transitory. So they're behind the curve. All three of the last rate increases aren't even in the economy yet. So wait until 2023 when this all filters through. You've got an inverted yield curve for a long period of time, which tells you have a longer and perhaps deeper recession coming. So what's the Fed going to do? They're going to pivot when the data says, wow, we're deep into a recession, or the recession started X number of months ago. I would do a full stop right now. They're not going to, right? But here's what we know about the Fed and about the markets. Markets bottom long before the Fed stops raising rates. In 1995, because 94 was crazy, 1995 rates, the market was at an all-time high. S&P 500, March of 95, all-time high. Fed stopped raising rates. The Fed's going to pivot at some point. Market will have already bottomed. So the market is leading the Fed by at least 3 to 6 months.
Well, how do you figure out when that is, where that is, what the bottom is?
Well, like everything else, you use data you have available. Last time I was here, I said Q4, more specifically October, should be either a low of significance or the end of the bear market. And now you've got data that says, well, we've got softening. For me, there's one catalyst from here that says the bear market's over. You'll know in January. If we all know that corporate profits are in trouble, they're declining, and you're going to see more cuts. If the markets don't react negatively to the bad news in January, I'll come back with my fist banging on the table. The bear market's over. If you do see negative reactions, then clearly what was priced in throughout 2022, the market's not fully done yet. To me, it's that simple.
Well, then you should all be in cash right now. Is cash the best investment?
No, I don't think so. In 2001, as the dot-com bubble was probably, halfway through its implosion, you had sectors making all-time highs. It wasn't until that nasty bear market of '02 with the Enron and the WorldCom that they rated everybody. Everything went down. So no, there's plenty of places and opportunities. I think you have to be more active, frankly. If you're a long-term investor, prune your portfolio. Figure out what you don't want to own you got stuck with. Take your tax loss if appropriate. And then rotate into things that perhaps look better, like the industrial sector. You've got insider buying, you've got a thrust in price activity, you've got really the rising tide in industrials is leaving all ships up. There are plenty of places you can invest right now. You don't have to just stick with Microsoft, Apple, Amazon, and whatever else you want to throw in there.
It's been a horrible year for you if you've done that.
It's been, except for the bond market, which has been the single biggest wealth decimation in history. Those mega cap tech stocks, people thought they would never go down. They were defensive in tough times and they were great in up times. We're finding out, just like the 40-year bull market and bonds ending, we're finding out that tech can go down too. And these elevated multiples aren't permanent.
What truly is high growth now? Because there was so much conversation in the bull market around what high growth tech actually is. And you had the emergence of FANG and FANG Mant later on and all of these other acronyms. So what is actual high growth?
If you remove those mega cap tech stocks that everybody has owned and they're over-owned, high growth will transition, will pivot bull market to bull market. I don't know, and you can throw in work from home too. I don't know where it all changed that a handful of stocks are the perma high growth stocks. Frankly, you bottomed October 13th. So what's beaten down the most typically goes up the most in the first leg of a rally. And we've seen that. Except for energy, we've seen the garbage is lifted, the most shorted, the most levered, the ones that have gotten beaten down without any earnings.
So you think the bottom's already in then?
I think a bottom of significance was in on October 13th. It's hard to argue that point. You've got a lot of supporting things, and the biggest one right now, you've got a seasonality tailwind that's probably the strongest tailwind. If you look at a president's 4-year term, this is the sweet spot right now. There is no more positive time than Election Day through April 30th after a midterm of a presidency. So it's also the 3rd year, which extends out. But this 6-month period has never been down since 1946. The 3rd year of a president has not been down since, I believe, Hitler invaded Poland, 1939. So seasonality, it acts as a great tailwind. This is more than just a little wind. This is a pretty big gust. But could we set a precedent and markets be down? Yes. But you're already down 25%. Anytime you've been down 20% plus in a midterm election year, that following year has been dynamite.
All right, let's leave it on a positive note here. Heritage Capital President Paul Schatz, always good to see you. Thanks for coming to the studio. We appreciate it.
Thanks for having me.